Chapter 16, Reporting the Statement of Cash Flows. So the purpose of the statement of cash flows is to report cash receipts, which are also known as inflows, and cash payments, also known as outflows, during a given period. This includes separately identifying the cash flows that relate to operating, investing, and financing activities separately. It is a detailed disclosure of individual sources and uses of cash. So that's what makes the statement useful to users. Information in this statement helps users answer the three questions listed in this slide. Information about cash flows can influence decision makers in some pretty important ways. For instance, we look more favorably at a company that is financing its expenditures with cash derived from operations than one that does it by selling off its assets. Information about cash flows helps users decide whether a company has enough cash to pay existing debts as they become due. It is also relied upon to evaluate a company's ability to meet unexpected obligations and/or pursue any unexpected opportunities that might pop up. Cash flows are defined to include both cash itself and also cash equivalents. The statement of cash flows explains the difference between the beginning and ending balances of cash and cash equivalents. So, what did you start with, what did you end with, and how did you get there? We continue to use the phrases cash flows and the statement of cash flows, but remember that both of these phrases refer not only to cash, but also to those items that we consider cash equivalents. Remember that to satisfy the criteria to be listed as a cash equivalent, you have to be 1, readily convertible to a known amount of cash, and 2, be sufficiently close to maturity that market value of whatever cash equivalent would be unaffected by changes, short-term changes in interest rate. Since cash and cash equivalents are combined, the statement of cash flows does not report transactions between cash and cash equivalents, such as cash paid to purchase cash equivalents and cash received from selling cash equivalents. However, all cash receipts and cash payments are classified and reported on the statement in one of 3 different ways, depending on how it fits into one of these categories: operating, investing, and financing activities. Individual cash receipts and payments for each of these 3 categories are labeled to identify their originating transactions or events. A net cash inflow source occurs when the receipts in a category exceed the payments. Obviously, that would make a net cash outflow or use occur when the payments in a category exceed receipts. Operating activities include those transactions and events that determine net income. Examples are the production and purchase of inventory, sale of goods and services to customers, and the expenditures to operate the business. Not all items in income, such as unusual gains and losses, are considered operating activities. We'll talk about those exceptions later. This slide lists the more common cash inflows and outflows from operating activities. Investing activities generally include those transactions and events that affect long-term assets, namely the purchase and sale of long-term assets. They also include both the purchase and sale of short-term investments in the securities of other entities, except in trading securities, and also lending and collecting money for notes receivable. This slide lists examples of cash flows from investing activities. Cash from collecting the principal amounts of notes that result from a loan to another party are classified as investing activities. However, the FASB requires that the collection of interest on notes be reported as an operating activity. Also, if a note results from sales to customers, it would be classified as operating. Financing activities include those transactions and events that affect long-term liabilities and equity. Examples include obtaining cash from issuing debt and repaying the amounts borrowed, and receiving cash from or distributing cash to owners. These activities involve transactions with the company's owners and creditors. They also involve borrowing and repaying principal amounts relating to both short-term and long-term debt. GAAP requires that payments of interest expense be classified as operating activities. This slide lists examples of cash flows from financing activities. I should say that one there. Some important investing and financing activities do not affect cash receipts or payments. One example of one such transaction is the purchase of long-term assets using a long-term liability or note payable. This transaction involves both investing and financing activities, but does not affect any cash inflow or outflow. So, because of that, it would not be reported in any of the three sections on the statement of cash flows. Such transactions are reported at the bottom of the statement of cash flows or in a note to the statement because of their importance and the concept of full disclosure. This slide lists transactions commonly disclosed as non-cash investing and financing activities. The statement of cash flows must report information about a company's cash receipts and cash payments during the period. This slide shows the usual format. A company must report cash flows from three activities: operating, investing, and financing, as we've discussed. The statement then shows the net increase or decrease from those activities. Finally, it explains how transactions and events impact the prior period end cash balance to produce its current period end balance. Any non-cash investing and financing transactions that are still important would be disclosed in a note disclosure or a separate schedule altogether. Preparing a statement of cash flows typically involves 5 steps. Listed out here, 1 through 5. 1, compute the net increase or decrease in cash. 2, compute and report net cash provided or used by. And then 2, 3, and 4 are operating, investing, and financing activities. And then finally, the last step, compute the net cash flow by combining net cash provided or used by each of the 3 categories, and then prove it out by adding it to the beginning cash balance to show that it does in fact equal the ending cash balance. Computing the net increase or net decrease in cash is a simple but very important computation. It equals the current period's cash balance minus the prior period's cash balance. This is a bottom line figure for the statement of cash flows, and obviously checking it out to make sure that it adds up correctly is an important accuracy check. Now, a company's cash receipts and cash payments are recorded in the cash account in the general ledger. Cash account is therefore a natural place to look for information about cash flows from each of these 3 categories. To illustrate, look at the summarized cash T account of Genesis Inc. that's shown in this slide. Cash account increased $5,000 from $12,000 to $17,000. Individual cash transactions are summarized in this cash account according to the major types of cash receipts and cash payments. For instance, only the total of cash receipts from all customers is listed. Individual cash transactions underlying these totals could number in the thousands of transactions. So obviously that would be quite the amount of paperwork there. Accounting software is of course available to provide summarized cash accounts. A second approach to preparing the statement of cash flows is analyzing non-cash accounts. This approach uses the fact that when a company records cash inflows and and outflows with debits and credits to the cash account, like we talked about in the prior slide, it also records credits and debits in non-cash accounts, reflecting the double entry accounting way of recording transactions. Many of these non-cash accounts are balance sheet accounts. For instance, from the sale of land for cash, you would have a cash account and a land account. Others are revenue and expense accounts that are closed to equity at the end of the period. For instance, the sale of services for cash yields a credit to service revenue that eventually would be closed to retained earnings at the end of the period. Information to prepare the statement of cash flows usually comes from 3 different sources: comparative balance sheets, current income statement, and some additional information. That additional information often includes details on transactions and events that help explain both the cash flows and non-cash investing and financing activities. You can take a look at these practice questions on your own. I actually usually delete these out of the slides. That's okay. All right. Cash flows provided or used by operating activities can be reported in one of 2 ways. You've got the direct method or the indirect method. These 2 different methods apply only to this particular section, just the operating activities section. The direct method separately lists each major item of operating cash receipts, such as cash received from customers, and each major item of operating cash payments, such as cash billed for inventory. The cash payments are subtracted from cash receipts to determine the net cash provided or used by operating activities. The indirect method reports net income and then adjusts it for items necessary to obtain net cash provided or used by operating activities. It does not report individual items of cash inflows and outflows from operating activities. Instead, the indirect method reports the necessary adjustments to reconcile net income to net cash provided or used by operating activities. The net cash amount provided by operating activities is identical or should be under both indirect and direct methods. This equality should always exist. The difference in these methods is with computation and presentation of the amount, and not with the actual amount in question. To illustrate, we prepare the operating activities section of the statement of cash flows for Genesis. This slide shows the December 31st, 2014 and 2015 balance sheets of Genesis, along with 2015's income statement. We use this information to prepare a statement of cash flows that explains the $5,000 increase in cash for 2015 as reflected in the comparative balance sheets. This $5,000 is computed as cash of $17,000 at the end of 2015 minus cash of $12,000 at the end of 2014. Additional information for 2015 is listed in this slide. The indirect method starts with the accrual-based net income and makes 3 types of adjustments to arrive at cash flow from operating activities. Adjustments to the accrual-based net income include changes in non-cash current assets and current liabilities, adding back any non-cash items that are included to arrive at net income, such as depreciation and amortization, and adjusting for gains and losses on the sale of assets. On the next slide, we will discuss further the adjustments for changes in non-cash current assets and current liabilities. The adjustment to add back the non-cash items, such as depreciation and amortization on the statement of cash flows, would basically cancel out the fact that they were originally subtracted to arrive at net income. Since these items do not represent cash outlays, we would not want them included in the statement of cash flows. We'd also need to adjust for gains and losses that result from the sale of an asset. Gains are added on the income statement, with losses being subtracted to arrive at net income. Since the gains and losses do not represent operating cash flows, we cancel out gains by subtracting them and cancel out losses by adding them to net income in the operating section. The actual cash flow from the sale of the asset will be properly reported, in most cases, in the investing section. This chart explains how to treat a change in a non-cash current asset or current liability in the operating section of the statement of cash flows. To illustrate, the indirect method begins with Genesis's net income of $38,000 and adjusts it to obtain net cash provided by operating activities of $20,000. This slide shows the results of the indirect method of reporting operating cash flows, which adjusts net income for two types of adjustments. They are adjustments to income statement items that neither provide nor use cash, and adjustments to reflect changes in balance sheet current assets and current liabilities that are linked to operating activities. Adjustments for income statement items not affecting cash. The income statement usually includes some expenses and losses that do not reflect cash outflows. We've talked about some examples of these: depreciation, amortization. Others would be depletion, bad debt expense, loss from an asset sale, loss from retirement of notes payable, etc. When there are expenses and losses that do not reflect cash outflows, the indirect method for reporting operating cash flows requires the following adjustment. Expenses and losses with no cash outflows are added back to net income. Adjustments for changes in current assets. Decreases in current assets require the following adjustment. Add them back to net income. Increases in current assets would be subtracted from net income. Basically, any of these adjustments for non-operating activities, you would just reverse the effect of. This slide summarizes the adjustments to net income when computing net cash provided or used by operating activities under the indirect method. Again, you can take a look at these need-to-know slides on your own. The third major step in preparing the statement of cash flows is to compute and report cash flows from investing activities. We would normally do this by identifying changes in 1, all non-current asset accounts, and 2, the current accounts for both notes receivable and investments in securities, excluding again trading securities. We then analyze changes in these accounts to determine their effect, if any, on cash, and report the cash flow effects in the investing activities section of the statement of cash flows. Reporting of investing activities is identical under the direct and the indirect methods. Information to compute cash flows from investing activities would usually be taken from beginning and ending balance sheets and the income statement. We would use a 3-stage process to determine cash provided or used by investing activities. Step 1, identify changes in investing-related accounts. Step 2, explain these changes using reconstruction analysis. Basically, go back through and see what we did. And 3, report their cash flow effects. The third major step information about the Genesis transactions provided earlier reveals the company both purchased and sold plant assets during the period. Both of those transactions would be considered investing activities, and so are analyzed for their cash flow effects in that particular section. Plant asset transactions. The first stage in analyzing these the plant asset account and its related accumulated depreciation account is to identify any changes in these accounts from the comparative balance sheets shown in this slide. This analysis reveals $40,000 increase in plant assets, $210,000 to $250,000, and a $12,000 increase in accumulated depreciation, $48,000 to $60,000. The second stage is to explain these changes. Items B and C of the additional information discussed in an earlier slide affect plant assets. Recall that the plant assets account is affected by both asset purchases and sales. Its accumulated depreciation account is normally increased from depreciation and decreased from the removal of accumulated depreciation in asset sales. To explain changes in these accounts and to identify their cash flow effects, we prepare the reconstructed entries from prior transactions. These are not the actual entries by the preparer. To illustrate, item B reports that Genesis purchased plant assets of $60,000 in notes payable to the seller. We can see the reconstructed item B shown there. The $60,000 purchase described in item B and financed by issuing notes in a non-cash is a non-cash investing and financing activity. It is reported in a note or in a separate schedule to the statements. Next, item C reports that Genesis sold plant assets costing $20,000 with $12,000 of accumulated depreciation for $2,000 cash, which resulted in a $6,000 loss. Again, reconstructed entries shown. And finally, we've got the reconstructed entry for depreciation expense. Take a look at these need-to-know questions on your own. The fourth major step in preparing the statement of cash flows is to compute and report cash flows from financing activities. We normally do this by identifying changes in all non-current liability accounts, which would include the current portion of any notes and bonds, and the equity accounts. These accounts include long-term debt, notes payable, bonds payable, common stock, retained earnings, etc. Changes in these accounts are then analyzed using available information to determine any effect, if it exists, on cash. Results would be reported in the financing activities section of the statement. Reporting of financing activities is identical under either direct or indirect methods. So we use a three-stage process of analysis. Step 1, identify changes in financing-related accounts. Step 2, explain these changes, again using reconstruction analysis. And then 3, report cash flow effects. Information about Genesis provided earlier reveals 2 transactions involving non-current liabilities. We already analyzed one of those, the $60,000 issuance of notes payable to purchase plant assets. This transaction is reported as a significant non-cash investing and financing activity in a footnote or a separate schedule to the statement of cash flows. The other remaining transaction would involve non-current liabilities. That involves non-current liabilities, I should say, is the cash retirement of notes payable. The first stage in analysis of notes is to review the comparative balance sheets shown. This analysis reveals an increase in notes payable from $64,000 to $90,000. The second stage explains this change. Item E of the additional information provided earlier reports that notes with the carrying value of $34,000 are retired for $18,000 cash, which resulted in a $16,000 gain. You see the reconstruction of that entry shown above. This entry reveals an $18,000 cash outflow for retirement of notes and a $16,000 gain from comparing the notes payable's carrying value to the cash received. This gain does not reflect any cash inflow or outflow. On this final slide, we see the Genesis information reveals two transactions that involve equity accounts. The first is the issuance of common stock for cash. The second, declaration and payment of cash dividends. We'll take a look at both. The first stage in analyzing common stock is to review the comparative balance sheets from slide 43. I think that was 43. Hold on. Yeah, there we go. Which reveals an increase in common stock from 80,000 to 95,000. The second stage explains this change. Item D of the additional information provided earlier reports that 3,000 shares of common stock were issued at par for $5 a share. Reconstructed entries of that information is shown. That entry reveals a $15,000 cash inflow from stock issuance. The first stage in analyzing the retained earnings account is to review the comparative balance sheet shown earlier, which we've already talked about. This reveals an increase in retained earnings going from 88,000 to 112,000. Then we explain the change. Item F of the additional information provided earlier shows that we paid out 14,000 in dividends. There's the reconstructed entry. We've now identified and explained all of the relevant cash inflows and cash outflows from Genesis.